So 1 in 10, sometimes that number is 1 in 9 Americans have a self-storage unit, which to me is crazy. How many people in the room have a storage unit? Huh.
Chris.
That's much less than most people. You put 100 people in a room, you know, I would have guessed closer to 10. You guys are good. You don't store as much junk. You know, the interesting part about storage versus other asset classes. So I own some apartments personally. Every 10 years, we got to refresh them, right? If you're going to charge premium rents, you got CapEx that goes into those. A storage facility is a metal box on a cement pad. So long term, we generally are just repainting, right? There's not much CapEx. I did an Instagram video, I don't know, 6 months ago. This is how we turn over a storage unit. You open the door, you sweep it out, you shut the door, done. So for those of you guys who are in residential apartments, a little bit different, right? It's just a different asset class with some kind of unique things versus some other pieces. The other one is little infrastructure to maintain. Again, you'll see it when we walk through. After about 5 minutes at our site, you're gonna be like, all right, I get it. You know, it's a bunch of garages, and that's all it is. It's a bunch of garages. So an interesting asset class. It's grown a ton in the last 15 years. You guys, I'm sure, have seen new development all over the place. It's our biggest risk is new supply in a market. When we think about investing in a new market, the biggest risk is new supply. So we really stand on 3 pillars of kind of why invest in self-storage. The first one, everybody wants to talk about how is it done historically. So historical returns, how has the asset class performed? We're using a data set down here. It's called the National Association of REITs. If you guys have never seen it, it's a really cool database where they track all publicly traded REITs across all asset classes. For the last 28 years, they've been tracking data. So if there is a publicly traded REIT in that space, you can go see how that asset class is done. And for us, it's just a nice apples to apples comparator. In the last 28 years, storage has done just under 19% a year, which is pretty incredible. Comparative to some of the core asset classes in real estate, it's outperformed apartments, retail, office. Office right now is an interesting conversation. And the S&P 500. Or that same 28-year period, the S&P 500 did just over 8%. Storage did 19. If you had taken $100,000 and invested it 28 years ago in all of the self-storage REITs and invested that same amount of money in the S&P 500, you almost had, and compounded it every year, you had almost a 10x difference in where you end up in the other 28 years. So this stuff matters. What Dave is providing you access to, there is a whole nother world that exists outside of equities, and you can pick the right things, it generally turns out pretty well. So historically, storage has done really well. If you are like me, I believe everything is cyclical. So you're gonna have some ups and you're gonna have some downs. So the next question I would ask as an investor is, what's the downside protection? So in 2007, 8, and 9, storage outperformed all of the major asset classes. It lost just under 4% versus apartments, office, retail. S&P 500 got crushed. It was down 21% during that same 3-year period. So historically done well, in a downturn has done pretty well. And then for us as an organization, the consolidation opportunity is really why we're in the business. So for those of you guys, I was talking to a gentleman this morning. He's in the insurance business. Private equity is rolling up that space, right? It's happening with physicians' practices, dentists, all over the place. Private equity's chasing that roll up. Same thing happens in our world. We're taking smaller mom and pop operators and rolling it up into a larger portfolio. And that larger portfolio is more attractive to institutional capital because institutional capital has to write a big check. So there's value in us going around and taking all the little stuff and putting it into a big package, and that's the consolidation opportunity. It's happened in every asset class. Where's the car wash guys? Are they not in the room? They didn't want to hear about storage, Dave?
They're working.
Jeez. The car wash guys are doing the same thing.
We're building car washes, man.
Yeah, that's right, that's right. The car wash business, same thing, right? Ton of mom and pop operators all over the country. Private equity is going to consolidate that. Same thing's happening in self-storage. So for us, that's kind of the third pillar that we stand behind. The other thing I told you I was going to talk about is how did it perform during the pandemic. So self-storage demand is driven by change. We joke the 4 Ds of self-storage. It's death, dislocation, downsizing, and divorce. So if you have any of those 4 things happening, generally that's when you're consuming storage, right? You downsize, you're gonna put your stuff in storage. Someone passes away in your family, usually their stuff ends up in storage. COVID for us was the perfect storm. Not just us, the entire asset class. We had an incredible 2020, back half of 2020, 2021. Best in the history of the asset class. If you had called me in May, and Dave did, hey, what's gonna happen May of 2020? I would have been like, this is it, we're all gonna live under a bridge. I told you I'm not good at predicting the future. The exact opposite happened, right? People started moving around the country, they're working from home, they put their stuff in storage to create room. So the chart on the right here, blue represents 2020. So you have the different asset classes. Storage did pretty well, only outperformed by data centers, which makes sense, right? E-commerce was going crazy during COVID. But look what happened in 2021. So storage is just under 80%. I mean, it was insane. Every one of our sites was full. Generally, we raise rates and occupancy drops. We raised rates and nobody left. So we just kept raising rates, and everybody did. So you'd say, hey, I'm pissed off that you're raising rates. And we'd be like, go down the street. And they'd go down the street and they'd be like, well, it's the same price. Okay. So we were very fortunate during COVID. I'm not telling you that we're going to have another recessionary period that looks and feels just like COVID, but historically, storage does well in an economic downturn. So as we head into the market that we're in right now, storage historically has been a good bet. Does that make sense? So last piece for me is what is self-storage or Reliant Self-Storage Fund for. So the property we're going to see today, we used to do individual syndications. So we would bring out a deal to guys like Dave and our investor base. So when Dave invested in Columbia, South Carolina, they invested in that specific asset. We launched our first fund in 2019, and we've basically done a fund a year since then. So we launched Fund 4 at the end of 2022. It's a $100 million targeted raise. We'll go out and buy as many storage facilities as we can, and think of it like a mutual fund of self-storage properties. We're about a third of the way through. We got 4 properties in it. Those 2 properties I mentioned that are closing today, that will be number 5 and 6. And we got 3 more in the pipeline. So we're just starting to hit our stride. I would guess kind of 12 to 15 properties by the time we get to the end of the year. If I were in your boat, I would say, well, you're in Fund 4. How have the previous 3 done? Anybody in the room in Fund 1? Is anybody in Fund 1? No? Okay. So Fund 1 was the first fund, $50 million fund. We traded it at the end of November of 21. It was part of that recap that Dave had mentioned. So, it was we didn't project it to be this. It was supposed to be a 6-year hold. We traded it in just under 2. And returns were about 30% a year. So if you had invested 100 grand, we returned 160 grand to you in just under 2 years. That number fluctuated a little bit depending on what class of share you had, but that was the low end of the return. Fund 2 is doing great. We launched that one right smack dab in the middle of COVID. Raising capital when the world was falling apart was an interesting time. We launched it in April of 2020, and we're like, hey, who wants to give us money? And it was a little slow for a while. But everything we bought in 2020 is going to crush. Fund 2 is 37, I think as of the end of March, 37% above projections right now. So Fund 2 is going to be a home run. And then Fund 3 was another $100 million raise. We closed at the end of September of 22. And it's okay. It's basically right at par right now. We've had some interesting challenges with it, but it's going to be okay. It'll be okay long term, but it's about at par. I think it's a little bit above projections right now, about 9%. So we've done this before. It's not a new model. Essentially, we aren't a great cash flow play. If you're chasing cash flow, Dave and team, and there's other opportunities out there that are better than us. Most investors have invested with us for the back end pop. Our appreciation has been where most people do really well. We're okay on depreciation. For those of you guys chasing tax benefits, remember when you're depreciating stuff, we're a metal box on a cement pad. There's not anything to depreciate, right? It's not like a hotel. Gas and oil's got some crazy. I know the ATMs do too. there's not much to depreciate. So we're okay on tax shelter. We're okay on cash flow. Most people invest with us because of that back end pop. So high level, we'll kind of split us up in two pieces. There's a couple things I just want to highlight to the office. So you walk in, it's clean, it's comfortable. We are generally trying to make this look and feel like any type of retail place that you've gone. It's not quite a Starbucks, but it's light, airy, feels good. All of the sites, and Brian can speak to this, generally are set up the same. You have kind of the point of sale items on the outside, right? Bubble wrap, locks, tape, boxes, those types of things. Generally, if people are moving, they need storage, they're going to buy that stuff here. It's the nice tie-in between U-Haul and the moving and the storage facility as well. One thing you guys may or may not have noticed is, did you see the QR codes on the doors? We are, as an organization, trying to find ways to make leasing easier for tenants. Online leasing in the last 3 years has become a huge part of our business. Brian is our market manager here, North and South Carolina. Do you know percentage-ish of leases that are coming online versus people walking in the door?
Probably close to 75%.
Wow. So, no, I don't mean to say no one, but most people don't want to talk to people. They'll scan the QR code, they can fill out their lease online, they can get a lock, they can get a gate code, so they never actually have to talk to us. COVID, for us, accelerated that plan, right? When people couldn't come in an office, if you didn't have online leasing, you were doomed. Does that make sense? So we're trying to implement as much technology as we can. We have a call center where, if our team here is on the phone, they're out hooking up U-Haul trucks and somebody dials in and they don't answer the phone, they don't get no one. They get a call center, and the call center will answer questions. They can take leases, whatever the case may be. The differentiator in storage is customer service, right? So it's a commodity, it's a box, and the ability to come in and talk to a human is valuable. And in our world where we're doing lease ups, we think there's a huge component to having people drive lease ups at sites where they're empty. We have our teams will go to sites that are empty to help get those leased up.
Cover the employees.
Yeah, we have, Arlen, to your point, like U-Haul in some of our sites on a weekend is a zoo. We have a site in Lutz, Florida, just north of Tampa, that does an incredible amount of U-Haul. We have 3 or 4 people there on the weekends just to cover the U-Haul traffic that drives through the door. So you're right, you lose some of this, but there are some sites in some markets where this is a very small percentage. So, we reduce hours, and because we're always playing with the expense side of this business, right? If we can grow revenue, that's great. If we can reduce expenses, also great. We have a pricing algorithm tool that literally pricing is changing daily based on our occupancy in the units and what's happening in the market around us. So if we're full on a particular unit size, we're going to raise rates, right? Because if we're going to sell one more unit, it's going to be at the highest rate we can possibly get. If we're essentially empty or have low occupancy in a particular unit type, we're going to lower rates to try to get people in. So that rate is constantly changing, and that's how we're trying to squeeze, essentially as much revenue as we can out of the property. So this is the most common unit in all of self-storage. Right, this is what everybody marks as national averages, is the 10 by 10. So the other thing, keep in mind, when we walked in, all the lights were off. Everything's motion detector, right? So hopefully we're saving power, so when no one's in here, all the lights shut off. The air conditioning and heat are kept relatively as most efficiently as we can. The things to kind of keep in mind, one, everything's white, right? So it brightens up an otherwise drabby building, right? I mean, it's just steel and insulation. With some mini split HVAC systems on the top. Everything's white and bright. It's clean. It smells good, right? You don't have like a musty smell. You want people to walk in here and feel like, hey, my stuff's going to be safe. I'm not going to walk out with mildew and rats. The question was, what's the occupancy at most of our? I hate to give you the answer. It depends. It depends. I mean, so we're trying to stabilize somewhere in the high 80s. 88% is usually what we're chasing, because if you're higher than that, it means your rents are too low, right? So we're trying to be around 88%. If we're higher than that, generally we probably got to raise rents. If we're lower than that, we probably got to lower rents to try to get the occupancy up. but we're trying to stabilize around that 88% side of things.